everybody. Good day, good evening. I'm a partner in the corporate group in Miller & Martin in Atlanta, Georgia. And on behalf of my co-chairs, Endrang with Wong Partnership in Singapore and Victor Strikovens with Cuatro Cacas in Spain, we'd like to welcome you to this meeting of the International Corporate Transactions Practice Group with the World Law Group. It's a great showing today. We had more than 100 people signed up. So thanks everybody for joining. Today's practice group meeting is a little bit different than others. We've opened it up to all the members of the World Law Group and also to some friends and contacts of our 61 member firms. So today I'd like to welcome Bob Bartel, David Blowers, and Jennifer Terrell. They're all from Kroll, and Kroll merged with Duff & Phelps a few years ago. And Bobby is the president and global head of Kroll's corporate finance business unit. Prior to his current role, he managed the firm's fairness and solvency opinions and founded the firm's first PE financial sponsor coverage team. He joined the firm in 1997 and specializes in a broad array of corporate finance engagements, as well as merger and acquisition transactions. He's worked out of their London office, clients in Europe, and many companies listed on several different stock exchanges. David Blowers is a director on the Kroll corporate finance team and the chief operating officer of their business. He manages their business leadership team and has extensive experience executing corporate finance and strategy engagements, ranging from M&A advisory to other corporate services. Jennifer Terrell is also with us. She's a director on their corporate finance team. So Bobby, David, and Jennifer, thank you for joining us this morning. Many of you may have joined our meeting with the corporate transactions group a couple of years ago with Duff & Phelps. Duff & Phelps joined us right at the beginning of the global pandemic to give us a market update at that time. And a lot has happened in the last 2 years since we were all together. I'd like to give a special shout out to Jeff Jefferson for reconnecting us with his friends at Duff & Phelps and Bobby and David and Jennifer to put together today's program. So with all that's gone on in the world the last couple of years and what's happening around us on a day-to-day basis, we thought it'd be very timely to get Bobby, David, and Jennifer to join us today and to give us the global capital markets update. So a bit of a roadmap. I'm going to hand it off in a second here to Bobby, David, and Victor to kick off the program. Victor's going to moderate this for a bit and field some questions from the audience, and we're going to save a little bit there at the end, probably about 15 minutes at the end. So go ahead and post your questions, keep track of them, and look forward to having an open dialogue along the way, and a lot of good conversations that always sort of comes out from people's different perspectives around the world. So with that, I'm going to turn it over to Bobby, David, Jennifer, and Victor. So thank you, everybody, for joining us.
Thank you, Joe. Thank you again to our guests. Actually, it's a very, unfortunately, when preparing this session, we were saying that we were not expecting to have such a timely, let's say, session, because considering the situation in the last months, but particularly in the last weeks, probably this session is going to be particularly interesting. So again, as Joe was saying, I would like to ask you the first question. I don't know who's going to break the ice. The first one is not directly related to the capital markets, etc., but perhaps it would be a good idea if you could elaborate a little bit and explain, how the Phelps and Kroll merger, acquisition, whatever. So because it was one of the questions that we raised at the beginning. So perhaps you want to say a few words about that. And after that, well, the main question would be how you see the situation in comparison with March 20, where we last talked. So I don't know whether Bob or David, you want to break the ice.
Thank you, Victor. This is Bob Bartel, and we really thank you for the opportunity to participate in your forum today. So thank you, Victor and Jeff and Joe and others. The first, interestingly, a lot of even my close friends would congratulate me recently and say, "Hey, congratulations on your sale to Kroll." And I would tell them, well, in fact, we weren't sold, we just rebranded, which some people sort of scratch their head about. Ultimately, in today's world, particularly in professional services, it's costly, and it's also complex and confusing to have multiple brands. And Duff and Phelps acquired Kroll approximately 5 years ago, and it's been a great marriage. The two businesses were generally in different areas of specialization. Duff and Phelps, the DNA is more valuation, M&A, and restructuring, so more traditional corporate finance and valuation type services. Kroll is a little bit more sort of 2032-ish, where their areas of focus are cyber and compliance, regulatory compliance in all different aspects, like anti-money laundering provisions and compliance with SEC and FINRA regulations, as an example. And then something we've all heard about and are talking about, which is data, right? All of us hear it every day. The words data analytics, data mining, artificial intelligence, etc. But given the DNA of Kroll historically, it was deemed, okay, we have multiple acquisitions around the world that we had made over the last several years, in Hong Kong, in Spain, in Brazil, in Canada. So we needed one firm, and we decided to go with one Kroll. And so you may increasingly see us. We just signed as a sponsor for a Formula E, not Formula One, but the Mercedes Formula E car, the new electric vehicle alternative to Formula One, partnering with Mercedes and other firms like SAP. So it's a new beginning, but it's the same firm, the same people. This is sort of street talk as opposed to official advertising language, but Duff and Phelps is 1932, the year we're founded. One Kroll is kind of a 2032 vision and image, because the world is changing so quickly with technology and data analytics, and so it was deemed this was the right approach. So thank you for that question, Victor.
My pleasure. So thank you very much for the explanation. And Bob, let's get into details, how you see the situation, mainly the comparison between March 20, last time that we had this similar session, and March 22.
Yeah, great, Bob. I'll jump in and take this. Can everybody see the screen just to make sure we're all up and running here?
Yep.
We
Perfect.
can.
Great. So as everyone mentioned, just fortuitously, or at least from a timing perspective, maybe not from what happened in the world, last time this group was together and Duff and Phelps was presenting, it was just about March 2020, 2 years ago today, and it gives us a really interesting and unique data point in time to compare what we're expecting to see in the capital markets. March 2020, we were all just about to go and start working at home. Markets crashed between, honestly, the date that we presented and the end of March, 37% of value lost in the Dow Jones. All of a sudden, people started working at home, unemployment skyrocketed around the world. And there was even actually some Russian antagonism at that time with some oil prices in wars with Russia and Saudi Arabia. Regardless, it was actually a phenomenal second half of the capital markets, doing $2 trillion in deal making. And then fast forward to 2021, and you had the biggest deal making year in history, almost $6 trillion in value. So with that in mind, we look at today, where the market is down again around the world. Europe maybe even seeing more so than the US markets. Everywhere is under pressure, with global inflation, surging prices, particularly in energy, and we still see some broad supply chain disruptions. And sure enough, Russia again, with a much more serious and real crisis going on in Ukraine. So the question and what we want to tackle today is, what's going to happen next? The million-dollar question: will global capital markets respond in a similar way, recover in a similar way? And the only way that we know how to do that as practitioners is to dig into the fundamentals. So I'm going to start with.
So Dave, and with that, before we go into the fundamentals, I also think that we all in business, law, consulting, investment banking, whatever it is, we're in a very unique situation, not just today with Russia, but all of us sort of, COVID is not over, as we heard from Andrew in Asia, but the psychology of business and the uncertainty is profound at this moment after a 2.5 year period of COVID and quarantines and in business disruptions and major impacts of all of our lives personally, how we go to work, how we go to school. The Russian-Ukrainian situation it's almost like it's like a sequel right away of great uncertainties that are somewhat unprecedented. So what I do know before I kick it back to Dave is, over the past 20 years now, we are in a world where maybe black swan events are not so black swan. Maybe they're a little bit gray. We have, we all know these things, but just sort of some notes I took. 2001, the terrorist attacks on the World Trade Center, which definitely changed the landscape and created sort of a battle zone in the Middle East. 2008 with the financial crisis, which spread globally, and the failure of firms like Bear Stearns and Lehman Brothers, and just to name a few, and the bailouts that governments had to provide. That wasn't that long ago. That was 13-ish years ago. 2020, 2 years ago, the COVID-19 virus, and then now today, no one would have predicted this in reality, say January 1st in their economic reports. So incredible uncertainty, incredible volatility, and some firms are going to be more well-positioned than others. So just unprecedented times, and no one really has a crystal ball, but companies have to get up every morning and push the boulder up the hill because their competitors are coming at them too. So thanks, Dave.
Yep. And just to dovetail off your topic on COVID, Kroll has a chief medical officer, which is a very 2022 leadership role, but apropos nonetheless to help us navigate what has become a very interesting work and hybrid work scenario. But the way that he laid out how we see COVID playing out, we'll touch on this real quickly, is 3 scenarios. First, that Omicron is a global endgame. Large swaths of the global population get this, but it starts to wane in severity and ultimately become an annual child respiratory type virus that we all know and deal with today. That would be fantastic. I think we're starting to see that play out in a lot of populations, and in that case, it would be something that would evolve from pandemic to endemic and is more manageable and predictable for years to come. He sort of scared us when he said the other scenarios would be Omicron continues to mutate and gets more, attacking the lungs. And then also the double whammy effect that public health institutions globally are dealing with, which is another pandemic over the top. When he presented this to us, I was like, wow, okay. I was thinking about this as, when can I go back to work? And they're dealing with much, much bigger potential problems. But nonetheless, I think everybody is starting to see and feel potentially scenario number 1 playing out, which would be most ideal and actually impact a lot of the other fundamentals we're going to touch on shortly if consumers start to return to normal pre-pandemic scenarios. Second topic on inflation. Everybody is seeing this, feeling this. It's particularly profound the last few weeks, given energy prices surging around the world. This isn't just a United States thing. The Euro area is trailing just behind. And I just wanted to highlight on the right side of this chart, for a long time, personal savings rates in consumers' pockets were coming up a lot because people were staying at home and not spending. All of that has come back down to normal, if you will. So the impact of inflation has basically started to take out the purchasing power of anybody who did a great job getting their personal savings rates up. So keep that in mind as to now we're kind of at the true inflection point of where inflation is going to have a big impact on consumer spending going forward.
And Dave, with that, as it relates to the folks on the phone who are transactional corporate lawyers and litigators, the one reminder that I have to myself is it's easy to think about inflation as it impacts one individually. The most obvious being when you're filling up petrol in your automobile if you don't have an electric vehicle. But the amount of manufacturing and food processing all over the world where the inputs are things like natural gas will have serious implications on sort of this domino effect of inflation. This is more than just now a heated up economy where everyone is drinking champagne and celebrating and outbidding each other for just a home. This is going to have implications on chemical businesses, agribusinesses, transportation companies, obviously like the airlines. The point being, I would expect some bankruptcies and insolvencies that today we'd probably be very surprised about. But if this repeats what happened in even 2008, there one company that filed bankruptcy, a global chemical business, LyondellBasell. It was a merger of Lyondell Chemical and Basell, I believe, in the Netherlands, a global chemicals business. One of their inputs was oil. And not every company that files bankrupt is just a broken company. Sometimes you're just out of money and you could actually have a decent balance sheet. So some companies, their working capital is going to dry up instantly just from the price of energy and the inputs that they have to pay for their manufacturing. So the point of this slide is inflation is here, inflation is real, it's going to hit all of us. And there's always a lag effect on sort of how companies push this along to their customers. But I expect more surprises and certain companies facing financial distress that, say, if they were putting together their budget in December, would have never even thought it was a possibility to have financial stress in 2022. Thanks, Dave.
Yeah, it's a great point, Bob. And I think this next page shows exactly what you're getting at. Any company exposed to these commodity prices, from oil to gas to cattle, corn, soybean, sugar, 1 year performance over on the right side in the green box, everything is up. Everything has become more expensive as an input cost to companies. And just to build a little bit on what Bob was talking about, I couldn't agree more. It's going to be a mixed shift of companies that can handle that and companies that can't. I view airlines, for instance, as they're going to really suffer with rising oil and gas prices, but maybe they're going to be able to offset that if sort of a post-pandemic pent-up demand of consumers are willing to pay the cost to still travel if they haven't done it for a few years. So they might weather the storm differently than a global plastics company that is simply using oil as an input cost and can't pass through. So those are the dynamics that we're thinking about as it pertains to individual companies and the impact of growing commodity prices. It is worth noting, Bloomberg forecasters see this as potentially near the top in the back half, all of these prices starting to wane back a little bit more towards equilibrium. But I think the big open question is going to be further escalation and sanctions on Russia. And if this gets into a huge energy war, that oil and natural gas specifically will be the real uncertain area for the year to come. Corollary to that topic, foreign exchange. Where do we see money flowing around the world? The chart on the right is all with respect to the US dollar of where the value is strengthening and weakening relative to a few global currencies. We're seeing in general, in uncertain times, money is still flowing to the dollar against the euro, pound, Japanese yen. It's going the other direction against the yuan and the Brazilian real. And I think it's also worth specifically noting that the euro is down a lot. In year to date, down 4% versus the dollar, 2% versus the pound, 10% versus gold, as they're more exposed both to the energy and then also just being close to the crisis in Ukraine and Russia. Finally, the ruble taking a huge hit. They are down 6% in the last week. They're down 45% against the dollar for the year, 40% against the euro for the year. And even despite huge efforts from Russia to sort of reduce their exposure to the dollar and other global currencies and just sort of balance out, they're still clearly feeling the heat. And then this also builds on Bob's point of kind of what we see in the markets. First of all, again, green box on the right side. Global equity markets over the last year, a lot of them are up. That's including the start of 2022, which you can see more red and things going down. The market has been very frothy, very successful, and the long-term performance even more so. That said, volatility index is up over 30. Traders are expecting it to get even higher towards 40, which is portends a lot more uncertainty for what happens next. And you can see that play out exactly with rising bond spreads and interest rates, which, to Bob's point, can lead to heightened credit and default risk. And we just laid out mining, agribusiness, energy, iron, steel, companies that are exposed to those risks. And you're already starting to see sort of prices on their bonds move into a little bit higher areas.
And I think one thing to consider with this as well is, let's consider the S&P 500 for a second, and almost in amazement, wonder how did it perform the way that it did during a very challenging time during COVID. Well, these companies are the marquee companies of the world. The same with the FTSE 100, the same with the Hong Kong index, the German DAX. Most of these businesses directionally are very different than many of our clients, your clients on this call. Many companies have no debt, loads of cash on their balance sheet, have incredible brands and or technology that is proprietary and defensible. They're paying dividends, they're buying back shares. They can play the long game. And so investors also globally, I think, look to some of these key markets and recognize that they do pay a dividend relative to what some of the interest rates one could earn as a saver and depositor. And even though you may look at the S&P 500 and it's sort of affiliated in the United States, and these businesses are listed on US exchanges, in fact, well over 40% of the revenues, possibly more for some, are not even based in the United States. No different than a BMW in Germany selling to the world, or also, a company like, just like a Danone yogurt or something in France. These are global businesses. So it's easy to think these are local trends, but in fact, there is a correlation between these. But the point being, there is a disconnect, because we all read the morning sort of news digitally or in print on business, but these are the world standards. And so I am fairly optimistic about these businesses. It's the middle market companies that don't have the balance sheets and the financial agility to withstand a prolonged downturn, and don't know if they should invest in a new machine, in a plant expansion, or in acquisition. Thanks, Dave.
Yeah, thanks, Bob. That's a fantastic point. And just one final quick touch in the sort of what we're seeing in the macroeconomic sense. Cryptocurrency, some interesting trends we've seen in the last couple of weeks. So it is highly correlated with risk assets. And to actually prove that point out, we are seeing a ton of activity of people moving into crypto, Bitcoin, et cetera, in Russia and the Ukraine. It's 17.4 million Russians own it. It's 12% of digital asset value globally sits in Russia. Ukrainians have an even higher uptake relatively. 13% of their population own it. They're ranked number 4 globally in crypto adoption, and that has skyrocketed over the last couple of weeks, to the point where there is more volume of crypto transactions processed every day in Ukraine than in their own domestic currency. So clearly it's an area that is people are looking to in a time of uncertainty and access to their own physical funds. And then just as we look ahead at this, keep an eye on the regulators. The news this week had executive order in the White House talking about potentially regulating this a little bit more aggressively, and how that maybe shifts from a uncertain risk asset to a true digital standard and asset, and maybe tie that a little bit more to the to domestic currencies around the world. Anyway, so with that view on the fundamental space, now I want to jump to, so what does that all mean, and what are we seeing with our clients, and specifically in the middle market, as Bob was touching on, in what's happening in the capital markets? What are the big major themes? And then we'll dig in on each of these. Bob, do you want me to run through, or do you want to take from here?
No, please run through.
All right. So overall, I'll just touch on these quickly, because then we've got to back up on each topic. We're going to look at market multiples and then do a little bit of a fact check on perception versus reality, on how high and how costly things really are. We're going to look at the credit markets and as a sign of how active and how ready investors are to put money to work. And then a couple big trends we're seeing in the market with respect to SPACs, secondary investments and continuation funds for private equity firms, and also just going private transactions that we're seeing on global exchanges. So let's start with market valuations. I think everyone on this call has probably heard over the past few years, the market is overvalued, multiples are higher than they've ever been. Whether that is a investment banker that is just trying to make a sales pitch or not, we looked at the data, and the facts are, look at the right-hand side of this. Whether you're looking at PE multiples or EBITDA multiples, the one-year change is down for everything, and quite significantly. The peak on sort of value has been reached and come down to the point that companies are going to be a little bit more affordable. So we think friendlier buyer's market could actually help maintain some of that deal-making momentum that we saw in 2021, despite all of the other geopolitical challenges. Credit markets, meanwhile, we'll split this between what we're seeing in Europe and the US, where most of our teams are sitting. Kind of a mixed message. Like, it's been extremely busy. 2021 again, the most leveraged loans in history. Expect there's still to be some pent-up demand, but come down a little bit given all of the concerns that we've already laid out. That said, fundraising has been off the charts. There's still a lot of dry powder in the markets, and people are going to be looking for good deals to put their money to work. And also, you're seeing prices start to play out and widening in the spreads, which are just going to entice people to come in and participate in the market. So very micro level, in the US, we actually only saw one deal launched in the past week, with 3 pulled from the market, which is kind of an early canary in the coal mine of, are people going to be less willing to lend on some middle market deals? Possibly, but that would call it the height in the first week of sort of geopolitical tension and news, and we'll hope that is not a sign of broader things to come. And then let me hand off to Jen Terrell to walk us through a little bit of her expertise on what's going on in the SPAC and secondaries markets.
Great, thanks, David. Hi, everybody. So SPACs continue to be a very hot and evolving topic in market trends, as evidenced by activity over the past couple of years. So we've seen record number of IPOs year after year, with remarkably high rates of successful de-SPAC transactions getting completed. However, so far this year in 2022, we've only seen IPOs at about 20% of the level that was achieved thus far at this time last year. So there's definitely a bit of a slowing in the market, but it isn't surprising just given how strong last year's activity was. So even last year, we saw some slowdown in the market in April when the SEC released accounting considerations for the classification of warrants as liabilities on the balance sheet instead of equity. So it forced all SPACs that were considering an IPO to go out and get their warrants valued, put them on the balance sheet. Even those that had already IPO'd had to go back and consider restating financials, or at least including those going forward. So it did put a bump in the road in terms of the pace at which SPACs were IPOing, but nonetheless, they continued to really boom throughout the year. Overall, SPAC activity has slowed both in terms of IPOs and transactions for a number of reasons. The first being the SEC guidance on warrants specifically, but also just heightened scrutiny and attention on de-SPAC deals. There's also an abundance of capital in the market looking to get deals done. So with so many SPACs out there searching for acquisition targets, there's a lot of competition to find attractive targets and get the deal done. And thirdly, sort of related to that competition, is that there's been a bit of a softening in the PIPE market since the beginning of 2021. So that's that's just created longer times to get deals done in the SPAC space. That being said, 2021 was still a phenomenal year for SPACs. Nearly 200 de-SPAC transactions were completed during the year, and even more were announced that are expected to be completed in 2022. So far this year, we've seen 20 of those previously announced SPAC transactions actually get completed this year, with another 25 being announced that will ultimately close at some point this year. So we do see continued momentum in the market, but it's definitely at a slower pace than what we were seeing a year ago. Also, if we were to judge the success of SPACs based on the number that have had to liquidate, it's also been a really successful market for SPACs, because only one SPAC liquidated in 2021, and thus far this year, only one SPAC has liquidated. So 2 total in the past since the beginning of 21 year to date. However, that being said, there are over 50 SPACs out there that only have 6 months or less in their life cycle to complete a transaction that have not yet announced a transaction. So we do expect that the number of liquidations to increase in 2022. and going forward. In terms of the industries, oh, sorry, can you go back? In terms of the industries of the de-SPAC transactions, TMT continues to dominate, given the market, but consumer and healthcare, including biotech, also comprise a decent number of the deals that we're seeing. And perhaps even more intriguing than the industry, we are seeing a lot of SPACs complete transactions with companies that are either pre-revenue or pre-earnings. So very early stage companies that are going public via SPACs and maybe otherwise wouldn't have successfully completed an IPO. So for example, one of our industry classifications here is electric vehicles. And that's really grown over the past couple of years and is definitely comprised of earlier stage companies. So definitely something to continue to watch going forward is looking for, the younger companies that have aggressive projections and just the level of scrutiny that they receive from the SEC. And while we've been focused on primarily US listed SPACs, there's no shortage of SPACs out there looking for targets across the world. We've also seen recent new listing rules introduced in Singapore, Hong Kong, and the UK. So it's definitely a trend that we should watch on exchanges worldwide. So then moving to the next topic of—
Yeah, but before you go on, I just want to say a couple things on SPACs that I think are important. There certainly have been a number of SPAC mergers with pre-revenue businesses, but we also see that SPACs will not go away. There is a great economic incentive for the sponsor to consummate a transaction. So we do see this as a parallel alternative and competitor with a traditional private equity buyout. So more and more companies, I think you'll see as SPAC targets as a way to become public, have an acquisition currency to expand. And that is important. What we have seen just from a investor standpoint and also to protect the board and the officers is it's even coming from the D&O insurance brokers who are placing the D&O insurance with the SPAC companies and boards, requiring fairness opinions, but also requiring, this is a new trend, I'm going to put in sort of quotes, an audit and independent review of the forward-looking financial statements. So no one has a crystal ball to guarantee the future, but there is an expectation that the projections will be reviewed and challenged by an independent expert who's advising the board on the terms of the merger. So point is, certainly it is a little bit uncertain today, but I see SPACs not going away because they have a lot of capital and they will be almost a public alternative to private equity buyouts. Thanks, Jen.
Right. So another transaction alternative pertains to related party transactions, and specifically GP-led secondaries or continuation fund transactions. So just to provide a little bit of background, a GP-led secondary recapitalization transaction occurs when a portfolio company is sold from a fund to a newly formed continuation fund that'll be capitalized in whole or in part by new third-party investors, but managed by the same GP. So GP-led secondaries is a great way for the GPs to provide liquidity to the existing LPs while remaining invested in the asset prior to being ready to exit via either a traditional sale or an IPO. And so if a fund is nearing the end of its life, but the GP believes that there's still a lot of unlocked value in the asset, a continuation fund is a great alternative. Driven by strong financial performance and high valuations of the underlying assets, we've really seen a surge in related party transactions activity since the second half of 2020, driven in part by the GP-led secondaries, specifically And we've also seen this trend continue throughout 2021 and even into early 2022. So we expect to see this continue as more and more funds look to continuation vehicles for liquidity. Also, continuation funds are prevalent throughout the entire ecosystem of private equity sponsors, irrespective of the fund size and including VC and growth equity deals, which we've seen driven by demand for later stage technology exposure recently.
And
So
I
the
think,
data.
I think on this one, if you go back 10 years ago, it would be unheard of for a private equity fund to merge two of their portfolio companies. But there's been a trend towards specialized industries and a slow death of the generalist private equity fund. So you can imagine if a private equity fund invests in telecom or invests in energy or food products, it often makes sense for their portfolio companies to merge and create value sort of in a 2+2+5 way. There's also another situation that we came across, which was a company that it was a little bit long on the tooth, but then it picked up a couple major accounts and had a clear vision of a 2-year backlog. But some of the LPs, unrelated to the company, wanted liquidity, and others knew I can be patient and take advantage of what could be a doubling of value in 2 to 3 years. And so some of these are also about LPs having a choice to roll into kind of the new entity special purpose vehicle or to cash out and get liquidity today. So call it financial engineering, but I would point out that it started 3 to 5 years ago with the large caps, the Apollos, the Carlyle groups, the Hellman and Friedmans. We're seeing this now in the low mid market as well. So this is where I think it is relevant for all of you that have private equity and venture clients, just the options available to continue to hold a company, but with a different profile of investors for the next 3 to 5 years.
Thank you.
Great. And then, so just maybe 2 more quick topics here, and then we'll open up the floor to Q&A. The last sort of trend from a sort of global capital markets perspective that we've seen with clients and have worked on with is more going private transactions on global exchanges. U.S. companies specifically that we work with that are maybe looking to limit exposure to Chinese public markets. There's a big backlog for this, and there's even 9 potential transactions that have been announced but yet to be completed in the coming year. And you just see sort of the trend of this happening and potentially happening more given all of the prior geopolitical stuff that we touched on at the beginning. And with that in mind, that's kind of where I wanted to close out. Our view on the without going into a ton of details on the Russia-Ukraine, just looking at this from a strictly capital markets perspective and the things that we're monitoring that are going to impact us and our clients. You know, there's an old saying from an economist that said, when goods don't cross borders, soldiers do. And what we want to understand is the opposite true as well, right? If soldiers have crossed borders, what's going to happen now with global markets? And will we see a quick end to this conflict? Are we potentially headed for a stagflationary environment with low growth and high inflation? All of those things are on our mind. So at Kroll, we're trying to monitor commodity prices going forward. Let's really keep an eye on what is staying high and moving with inflation and how that will impact specific companies, which leads directly to 2. Will we actually see a slower tightening of monetary policy? I think it's probably fair game to assume the US is going to raise rates in the coming weeks here, but are they going to do 3 raise rates over the course of the year? Is the ECB going to follow suit? We'll see how that plays out as the coming weeks go by. And then 3 is a really interesting point about general mix shift in impact on global companies. There's going to be tailwinds in some industries here, regardless, whether it's cybersecurity, clean energy. If oil and natural gas become more expensive globally, your marginal cost to do that new clean energy project is getting closer and closer to where it needs to be. And there's probably a lot of countries and companies that are already close to that. So I expect personally to see a lot of clean energy change, specifically in Europe, which is already ahead of the pack there. Aerospace and defense clearly too. Whereas Bob mentioned earlier, headwinds on any companies and industries that are impacted specifically by energy prices. And then finally, 4 and 5 here, if there's ripple effects, if we start to see a China-Taiwan crisis, and that's going to then get dovetail into the semiconductor industry and just more global uncertainty, I don't know what to tell anybody there. Then sort of all bets are off and we really need to buckle down. But then number 5, as it pertains to the middle market and our clients, I think the peak of globalization might be in the rear view mirror. Not saying I'm anti-globalization, quite the opposite, but we're going to see some global to local trends, which has a higher impact on middle market companies, localized companies, smaller businesses that are probably working more within their domestic economy than others. And you're actually starting to see this with big companies too, that are trying to invest to bolster their supply chains to make sure they're not globally exposed to situations like a pandemic or global tensions. So overall, a lot to think about, a lot of uncertainty, and yet I hope that we gave some interesting insight that there might continue to be a positive deal-making environment in 2022 and the years to come.
Thank you, David, Bob, and Jennifer. I've made a lot of information in 45 minutes or something, so it was really interesting indeed. I was about to ask whether you were optimistic or not. In general terms, I'm skipping the last slide, but in general terms, at least when you were talking about the M&A market, etc., and M&A guy. So I saw that, particularly when it comes to Europe, you were reasonably optimistic about the 2022. Actually, we not only at Cuatro Casas, but I would say in Europe in general terms, we are quite busy, at least until the Ukrainian situation. So let's see how the situation evolves. But so far there is quite a bit of activity. I do have questions, but I guess that if anyone wants to ask a question, is more than welcome. I think that in the chat, or I mean, either by the chat or raising the hand by physical means or by electronic means. Otherwise, I will ask one of the questions that I saw in the chat. No questions.
Go ahead, Victor.
I will. Okay, other than the one that I got, but well, one of the questions that I would have is whether you already touched that more or less, but is whether you foresee a slowdown of the cross-border transactions, in the sense that, again, we do see a lot of activity for the time being, at least in Europe. In the US, probably a bit less, but on many occasions it's domestic. But I was wondering whether you have any particular thoughts when it comes to international M&A or international transactions, not only M&A.
Yeah, it's a great question. Bob, do you want to go, or I'm happy to tackle it?
Yeah, let's both do it, but you can start.
Great. So at the beginning of the year, Victor, I would have said do not expect to slow down at all. In fact, cross-border should potentially be coming back with a vengeance, given a reduction in COVID restrictions, sort of a pent-up demand of global exposure and an opportunity to invest in, even certain industries that might be more regionally focused. Of course, I think we would point back to that discussion on Ukraine and saying that we're going to see a mixed shift. Maybe there's some Europe to US cross-border, but more muted activity within local countries and economies, and maybe some countries that are less willing in general, and maybe try to keep a more conservative cross-border approach to where they invest their capital. So that would be my general reaction, with finally the point of any mission critical industries or products, the opportunity to invest in good new cyber security technology, maybe clean energy, as we were talking about earlier. People will go over borders to make those investments. So I know that was a little bit of a caveated answer, but I think the overall, it's not going to slow down too much.
I hope that you are right for different reasons, obviously from a business standpoint, but also because that would mean that the situation, let's say, in the world has improved. Any additional question? I guess that, Hannah, we are supposed to finish at 3 in Spain, or I am mistaken, because I do have one additional question.
Yeah, Victor, I know you got sent a couple of questions in the chat, so I think you can go ahead and go with that, and we can give Andrew a little less time at the end. That's totally fine.
Or Andrew, nothing personal. The additional question that we got related to the private equity, the secondary transactions, you touched that matter as well. But we were wondering whether you predict that this influx, let's say, will remain. It's interesting, the fund to fund managed by the same general partners, etc. But other than that, do you expect more secondary transactions in the private equity world?
The answer is absolutely yes. Private equity, they're not smarter than PLC, publicly listed companies, but they can withstand some choppiness and a roller coaster ride for a 12 to 24 months. So they will more likely lean in and do some things that may feel uncomfortable when we have things like COVID and the Ukrainian conflict around. So there's a lot of money to be made for the LPs. There's a ton of money to be made for the GPs, and the lenders are smiling as well. So we expect this to not dissipate or soften, but to increase only further, because there's no more, it's not taboo to do these things. Now the US SEC just had sort of a proposed regulation on all related party and related fund. They were talking about hedge fund, private equity, venture fund transactions. So the LP committees will take a more important role than they ever have in the past. Maybe they were a little bit more passive and friendly. Now they have to act a little bit more like a board of directors of a public company. But we expect that to continue. And in fact, we've even seen, like at our firm, but other firms that are like Greenhill in PJT and Evercore, which play a little bit up market from where we play, they now have specialized teams within their M&A practices that do this. So if you think about an M&A banker, are you in the energy group or the consumer products group or the technology group? There's now a GP secondaries group, almost like an industry sector within these, Goldman Sachs and UBSs of the world. So this is something that everyone is sort of doubling down to. And like I said, if the LPs are making money, they're doing high fives, and the GPs are getting richer and richer, there will be transactions. They're quiet, they're discreet, they're even easy to do legally. And here's the other thing. There's always sort of risk in any transaction. You don't know the management team. You don't know what's really happening with customers. So a buyer will do their best to transact on a new target. But when one is familiar with people and they truly trust someone, it's going to only accelerate more deal activity of the known. You may as well sell yourself the same company, even if it's at a higher value than a third party, because they're just going to have to go out and find another company to buy. So it will be more incestuous in a good way for LPs. But just like, I mean, this is an amazing, and I'll end here, but it's an amazing evolution. 10 to 15 years ago, LPs even frowned upon a private equity to private equity trade. It was almost like if Apollo sold the company to Hellman and Friedman, they weren't adding value. You're supposed to sell it to, Conagra or, Siemens. That was value creation, a private equity fund creating value by selling to a strategic. Then it was a little bit taboo, private equity to private equity. Now that's all the rage. Now it's even deeper where it's, sort of self-private equity to self-private equity transactions in a sense. And there are new LP pockets, like if you talk to your personal financial planner, like your broker, and they pitch alternatives, half the alternatives they're pitching to me are these and it's funny because I just listen and I pretend like I don't know what they're talking about because I want them to tell me what they are saying. They don't actually know what they're really saying either.
That's true.
But they're pushing secondary private equity funds, the Hamilton Lanes, the Lexington Partners, and more that are starting every day just because there's so much out there.
Yeah.
Thank you.
Victor, I'm not sure if you saw in the chat,
Yes.
Kent in China did have a question.
I was yes. I think that I
Excellent.
was about to say this is the last question. Whether you could say some few words because some of the attendees understood that you were mainly referring to Europe and North America.
Yeah.
So any comments with regard to other relevant parts of the world?
For sure. It's a great question, Kent, and thank you for it. And yes, certainly we as an organization are a little more US and Europe focused, but we do have an APAC presence and certainly have a view on this. And I think in so few words, given in the interest of time, I would view cross-border transactions outside of those areas specifically as being less impacted by some of the global tensions. And if it's more difficult or more risky to be investing in areas of Eastern Europe versus Southeast Asia, where there could be opportunity or industries of specific interest with tailwinds that we were talking about before, I would imagine less impact on cross-border transactions outside of those regions.
Thank you very much. And now, yes, I'm going to give the floor to Andrew for final words and wrap up. Andrew.
Thank you, Victor. As we are running out of time, this just leaves me with the pleasure of thanking our speakers today, Bob, David, Jennifer. We are very fortunate to have you here today, giving us, guidance into trends and the future, everything from oil prices to Bitcoins and how all this will impact, credit, valuations, M&A activities, and capital markets in general. It has indeed been a very fruitful 15 minutes or so. And for those in my part of the world, something definitely worth staying up for. So on behalf of the World Law Group and all our guests who join us here, thank you so much for spending your precious time with us. And more importantly, sharing your insightful thoughts. Thank you. Thank you, Bob, David, Jennifer. Thank you.